what is the things that the business owner is financing, spending money on, you know, day to day.
Absolutely. And, you know, so one of the things that there are expenses that every business has, regardless of how much money you have at the end of the year, right? But so is there a way to reroute those expenses through the insurance contract? And so let's look at doing that. Okay.
Yeah.
And one of the things that's important is let's just say that there is they're going to use taxes as the example. Okay. But here's where we kind of differ from the point of Nelson's original writings and this chapter. And we talk about cash drag in the beginning. Okay. The weaker IBC practitioner or the novice IBC practitioner or people that don't use infinite banking on a daily basis that may write books, they don't understand that the cash drag is necessary in the beginning to qualify as life insurance, as we talked about last episode. But it's kind of like this. If you were going to run a race, do you want to start first or finish first, Nick?
I love finishing first.
Exactly. And do they publish in a marathon, like in an Olympic marathon, do they publish who started first after 1 mile, who was ahead?
No.
Nobody. Does anybody care?
No. Ask a PGA golfer, does he like being leader after day 1, or would he rather be the leader after day 4?
Absolutely. Because guess what? The guy that's the leader after day 4, what do they call him?
The winner.
The winner of the race, right? Okay. So that drag is the owner's contribution or capitalization in their banking business. And the drag is necessary to have an efficient enough policy down the road.
That's right. It is when you're advocating that you don't have that, you're ignoring a fundamental component to this, and that we need to focus on the volume, not the rate. Because if I were to show you the volume of interest coming to you 10 years down the road, I can tell you that you'd rather deal with that cash drag up front.
Absolutely. So let's go through their example. And again, I'm sorry, guys, if you're listening, the authors here, but somebody saying, hey, I can only really commit $20,000 and they're making $1 million, then they don't understand, or they haven't overcome the human problems from becoming your own banker. And they definitely haven't overcome Parkinson's law, right?
That's right.
I mean, they got a problem. That's what I'm trying to say. So I don't think this is a real life example. I've never had anybody making $1 million tell me they can put $20,000 into something.
That's right.
So again, that's us doing this every day and them looking at it from an academic standpoint. Okay. So what they say is, well, he has $100,000 in tax payments he must make. Now, by the way, okay, so if you're making $1 million, tell me where, and you're netting $1 million, tell me where I can pay $100,000 in tax, and I'm signing up. Okay. But so now he says, well, I'm paying him $100,000 in tax. I could put $20,000 extra in. So they show this example of $120,000 for 10 years and then dropping it to $20,000. So let's understand. And they're putting a 30-year term rider on there. Okay. Now, some of the companies have term riders that are as short as 7 years. Why? Why 7 years?
Well, 7-pay test.
7-pay test. If you listened to the last episode or watched it, then you would know. But do you think that if we have this 45-year-old in this example that's going to have a 30-year term rider, is that going to be pretty expensive down the road?
Pretty expensive and terribly inefficient.
Terribly inefficient. Okay. So what they do, just so you understand the 120,000, okay? You have $16,000 of base premium. You have $4,000 of term rider, and then you have $100,000 of paid up additions, right?
Yep.
Okay. And one of the things that they're building here, okay, before I go on with that, let me stop there. That's not how we would ever design a policy.
I'm already so distracted by the fact that I can only put 16,000 into this as a $1 million earner later in life. I'm so distracted and I'm already aggravated about it.
Yeah, because I'm going to show you, and I'm going to draw something out here, Nick, in a minute, and share the screen, and I'm gonna show you where this just really wasn't the way to do this. Okay, and why? I'm going to show you why. Okay, and they get into the death benefit and the term insurance and why they drop out the term insurance and all that. Okay, we're not going to get into that.
Yeah,
all right.
You know what? That works out to be 13% of the total premium is base.
Right. And they go through this in a scarcity mindset. Sorry, guys. Again, this is not the way, because these guys don't go out there and put this in motion every day. Right. What they're trying to point out is if you have this money loaned out, then you have this windfall, and you're using these expenses, and then you have this windfall. You can refill the hole that you made with the loan. Right.
Yeah, we can do it. We can construct the policy properly and get that same benefit.